So I think to begin with, if you're going to look at this idea of increasing the value of your company, you got to begin to change your mind a little bit. You know, you have a role in your company as a leader, CEO, whatever your role is, CFO. In a family company, this is kind of my experience with many companies is it's kind of everything's all in one pot. Yeah, you know, this is where our wealth is, but it's also where everybody gets their salary from, right? It's this sort of conglomeration of roles. But I think in order to, if you want to be serious about looking at the value of it and how to increase the value, I think you got to begin to separate this stuff. You got to be able to stand back from it, right? And you got to be able to look at it not only as someone in the business or maybe as a family member and somebody running it, but you also have to look at it and say, you know, what does it look like as an owner? Because you have a choice as to what to do with your capital, right? You could decide to leave your capital in the business, or you could decide to sell it and put it in other things, right? So fundamentally, I think it's very important, if you want to really stand back and look at this from a value standpoint, you got to separate, you know, these two, the way that you think about it. You have to put a hat on here that says, you know, what really does this business look like if I was to really stand back and look at it independently? And that means, you know, you don't count sort of, okay, well, we can take the profits out each year because that supports our lifestyle, all that other kind of stuff. You got to begin to think differently about that kind of stuff, because if you want to stand back and look at it economically, you have to begin to, you know, break it apart. You know, you can't look at it as just this sort of engine that, you know, the gardener's on the payroll and, you know, all this other stuff that goes through the business. And that's an extreme example, but, you know, there's an element of that, right? With most private companies, things go through there that may or may not, you know, if, in fact, I was talking to Scott Keaton's a CFO at one of my clients, and he's been with a public company most of his career, and now he works with one of our clients, and we were talking about how it's different. Public company, you want to do certain things. There's like all these rules, and more often than not, it's no, you can't do that. So now he's working with a private family company that we've had as a client for a long time, and he's doing a terrific job at helping them, you know, kind of professionalize that business and really do it the right way. But he's learning that private companies, you know, there's stuff that goes on, right? How many of us don't have stuff that goes on in the business that may not be the true economics? So if you really want to look at it, you got to begin to separate that thinking and begin to look at it as an investor. So let's talk about a couple definitions. It's very theoretical. The value of any asset is the present value of its future benefits, discounted at a rate of return that compensates you for the risk. This is basic finance stuff, right? Very theoretical though, right? So what does it mean? If you're able to have that perfect, I always think of a bond. If I have a bond of $1,000, it pays me a certain amount per year for a certain number of years, and I know what the interest rate is in the bond, I can tell you definitively what the present value of that investment is today, how much I should pay for it, right? It's math. The problem is that with using this definition, it's not that simple in a live business, because that interest rate or that coupon you get every year in the bond is not necessarily assured to be, you know, the same every year. So it makes it difficult. But that's a theoretical discussion of what value is. And here's what value creation is. It's creating a business when the business earns a return on invested capital that's greater than its cost of capital. Okay? So let's think about this for a minute, and anybody that wants to chime in. So every business has a cost of capital. And there's two components to it typically. If you think about the equity structure of the business, think about the right-hand side of the balance sheet. Left-hand side is the assets, right? And then you've got to think about how those assets are financed. And we'll get into more of this later, but this is more foundational. So in order to acquire all the assets, you have debt holders and you've got equity holders. You've got a mix of debt and equity. And there's a cost associated with each. The cost of the debt is pretty easy, right? Whatever interest rate you're paying on your debt. But then you think about what's the cost of your equity, okay? And that's where it gets a little bit more complex, because this is theoretical, but the cost of your equity is the cost of what you would put it to use in a substitution, right? If you used it for another purpose, similar purpose, what would you demand as a return on that capital in a similar asset? So the idea here is that if you can understand the risks and all the other stuff that goes in with determining what your cost of capital is, if your company earns a return in the way of cash flows above what your cost of capital is, it's creating value. Okay? It's sort of straightforward because an outside party that would buy your company or would value it is going to assess the risks, and they're going to put a rate of return on invested capital based on the risks of that business. So if you can earn a return on your own capital, and again, it's a little theoretical on your piece of the capital because the theory is that you have to look at a comparable return on a similar asset. And so there's ways to calculate that. We'll talk about that in a minute. But a company creates value when its returns on its own capital are greater than its cost of capital. Okay? Because the cost of capital is theoretically what an outside party would pay you for it anyway. So when you're earning higher returns than your cost of capital, you should be creating value.